Well, good morning, investors and traders. I'm going to do a brief video this morning. It is 5:20 a.m. on the East Coast. We're looking at equity futures here in the pre-market ahead of the markets open on Wall Street. We're going to jump into, we're going to scatter around. Got a few subject matter to discuss here this week. Hope you enjoyed this video. Hit the smash the like button, follow me on YouTube, and we'll see how this trading week goes. We're getting that much closer to the debt ceiling. I won't call it a crisis, but if they don't manage to raise the debt ceiling, well, it's not going to be a pretty day. Maybe 48 hours for the market. If I was to give you my take on the upcoming debt ceiling, there's a lot of political rancor going on, as if that's anything new. I'm of the opinion that it doesn't go to the 11th hour, but we actually don't have a deal in the 11th hour, so to speak. And, we push it over the edge. Essentially, markets die, the world dies for maybe 24 to 48 hours. And then the defibrillators come out, they revive things, they sign the deal, the market speaks, politicians pay attention. As I've often said, Washington doesn't make policy, the Fed doesn't make policy, the markets force policy. All right, with that said, let's go to our charts of the week. Okay. Interesting, right? This one's going up and to the right. This one is going down and down and down to the right. What are these two charts? Well, as I've got squared off here, this is the real M2 money stock. What a lot of people associate financial market liquidity with. Can't be further from the truth, but don't let facts get in the way of a sensationalistic narrative. And that's largely what we get from the media and a lot of the bearish commentary on social media. With that being said, let's go directly to the St. Louis Fed website so you can see what we're talking about here. Here is that chart of real M2 money stock. It doesn't look that bad as this one does, right? Doesn't look as bad. However, you can change the chart settings, as we've discussed in the past. Here we are. We do see M2 stock rolling over. And what we will do is adjust the chart to show what was seen in the other screen. So we're going to change it from the total billions of dollars to the percent change from a year ago. And that gives you a good idea of the year-over-year look in M2 money stock, or money growth, if you will. All right. And there you have it, folks. Not good, right? The worst, basically, in the series of this study's history. And this is, people associate this, well, if money stock is going down, the economy can't go up, and the markets can't go up. Again, anything further, they're going to be anything further from the truth. As we showed just a little bit ago, and why I want to go back to our original chart, put it back into billions of dollars. While M2 stock is down year over year, look at where we are relative to, of course, the pre-pandemic era. We could possibly draw in a trend line to see whether or not we're above trend, below trend, or what have you. And we're right about back to trend. Right? We're almost back to trend line there. So while on a year-over-year basis, M2 is down egregiously and has rolled over from the peak in 2021, we still have more liquidity in the financial system than most people care to consider. Again, the difference between this chart and this chart is one gets attention, one gets none, right? Because this one doesn't look that bad. This one does. Now, at the top, what do we have? We have money velocity. That's the actual change in transacting of each dollar in the economy. And we can see this is off the charts, just like M2 money stock is off the charts to the downside. Money velocity is off the charts to the upside. And why is that important? Well, it's important because it tells us that for each dollar in the economy flowing through the economy, there are tons of transactions taking place. For those who have wondered why in the heck, with the yield curve inverted, with housing transaction recession, with manufacturing recession, with consumer sentiment being so poor, how in the world are we staving off an economic contraction, a recession? Well, this is one of those reasons why. How does this happen? Wage growth, nominal or real. We have tremendous wage growth going on. Keep in mind, real wage growth is now in a like position going off the charts. How do we determine real wage growth? Well, you subtract inflation. So imagine wages are still going up, but over the last, 10 months now, inflation has been coming down. So you have that much more spending power from the consumer. We'll do the same thing. We'll look at velocity. And again, while this looks good, this looks like a nice configuration here. When we change the graph, we can see the power. This is just the ratio chart. We go to percent change from a year ago. I mean, it is stellar, folks. If you want to take an atom bomb to all the recessionary signals, this is your atom bomb. This is remember last year when we had retail sales growing 7, 8, 9%? People are like, oh no, it's just inflation. Prices are higher. And then, part of that is true. But money velocity, or the velocity of M2 money stock, tells you not exactly. This is not entirely a byproduct, or retail sales, consumer spending was not an entirely a byproduct of higher prices. This is telling you the actual dollars being transacted. Here you can get the definition of what money velocity is. And down here it will tell you, in other words, it is the number of times $1 is spent to buy goods and services per unit of time. If the velocity of money is increasing, then more transactions. There are actually more transactions occurring between individuals in an economy. So higher prices was one thing, but the higher this goes, the actual amount of transactions is being calculated for that $1 spent in the economy. This is transactional, folks. What is staving off a recession? Look at money velocity. I tweeted this out yesterday. Again, it doesn't get a lot of fanfare on in social media because, of course, this is like the atom bomb to a recession. And nobody wants to, see what do they call it? Rainbows and unicorns, right? Nobody likes rainbows and unicorns. It can't be. This is too optimistic. You're not thinking critically enough. Stop it. Yes, stop it. If you consider each of the last, 4 recessions going back to 1990, right? Because all we hear is this noise in the financial media about manufacturing, housing, higher rates, the Fed, inflation, it's coming down, but not coming down fast. I mean, it's all the negative stuff, the inverted yield curve, right? The dollar may have another surge, right? Because the dollar broke back above 102, the dollar index. Like, it's all negative. And people think, well, even you can't add all these. If you add all these things up, there's no way in heck that we're not going to have a recession, right? And all of these factors would be natural forces within the economy that lend themselves to the economy weakening and potentially a rate of change recession. But if you go back to 1990, you think about the recessions that we have had along the way, how many of them were produced by a natural rate of change leading to a recession? right? It was 1990 and that was it. And you can make the argument that 1990 came about because of the Gulf War, right? Every other recession happened through an exogenous event, right? In 2001, we had 9/11. You can make the argument that the dot-com bubble bursting only made the economy weak enough to where a national event, an exogenous event, a black swan pushed us into a recession. After that, we had 2008, massive deregulation. We had leverage through the roof, household balance sheet, corporate balance sheet. We have these exogenous types of financial instruments being used by the big money center banks that essentially, tipped us into a great financial crisis. That is not a normal rate of change recession. That is a black swan type event. And then after that, we had COVID, right? Is COVID a natural rate of change recessionary event? No, that was another black swan event. So when you think about all the things you hear about in the financial media or find on social media, what tends to push us into a recession is a black swan type, exogenous event. It is not normal rate of change. And no matter how many of these things that you hear in the financial media and you're adding them up, it generally does not produce a recession. So again, you won't find these. I was looking for money velocity on social media. I couldn't find one chart related to it until, of course, I posted this dueling chart out there yesterday. And this is a very unique environment. I wrote this out here since 2018, right? I mean, since 2018, things have gone haywire, folks. We had one global recession, of course, in 2020. We've had three bear markets. In 2018, we had a technical 20% drawdown in the S&P 500. Then, of course, in 2020 with the pandemic, and then in 2022. It's amazing. Three bear markets in 5 years. We average one bear market every 4.5 years since the 1920s. We've had three in 5 years, folks. We've had 3 years within that 5-year period where we achieved double-digit returns. 3 years of double-digit returns in between those bear markets. We've had 2 yield curve inversions. Yield curve inverted in 2019, yield curve inverted in 2022. We've had the effective federal fund rate, or the Fed's fund rate, go from 0 to where it is today, 5.10. Since 1945, over any 5-year period, there is one example of this, 2018 to the present day. We are living in unprecedented times, folks. All right, with that being said, how do we get money velocity looking like this? Again, all you have to go back to is the excess savings, household excess savings. And I realize that these charts look like they're falling off a cliff, but if I might read to you, and this is Bob Elliott's chart. He's formerly of Bridgewater Associates. Household excess savings are declining at roughly $60 billion a month, with $700 billion left, folks. There is $700 billion. Earlier in the year, JP Morgan and other big money center banks were forecasting that excess savings would actually be wiped out by June of this year. We still have $700 billion left. The rise in the savings rate suggests households drawing down more slowly than the pace projected 6 months ago. The next outcome is likely a longer, less significant support to spending, which means income growth taking on even more importance going forward. So again, a lot of excess savings on the household balance sheet. To me, this is the atom bomb to all these recessionary signals, in conjunction with what money velocity is doing. All right, I tweeted this out recently as well. Coming into this year, I was like, if you own energy stocks, you are your own worst enemy. Why? Look at how many shares are outstanding, people. Like, there's this natural, yet just exogenous, like structural impediment to the energy sector in 2023. The energy sector was working last year due to commodity prices skyrocketing hyperbolically to the upside. And S&P 500 energy sector companies were doing what was in their best interest, which was creating more shares, further raising capital for their business operations. Well, when you do that year, you're making it extremely difficult on your earnings per share results in the following year because you have that many more shares outstanding. It's why the energy sector earnings per share is forecasted to decline in 2023. Now, while I tweeted this newly updated chart for the Q3 period because it runs with a lag, just yesterday, I warned people about this last year, June 13, 2022. Total shares outstanding increased to highest level on record. Share issuance from these energy companies is the fastest pace since the turn of the century. They were issuing shares left, right, front, and center, and investors were gobbling them up. Insider selling, the insiders knew. The insiders knew this is not going to end well for the energy sector. I mean, they're not stupid. If there's one thing to follow in terms of insider selling, having some kind of valid signal, you go to shares outstanding. If this is increasing, more than likely insider selling is increasing for the reason that you should get out. 9 times out of 10, insider selling means nothing. But if you put it with shares outstanding increasing to the degree that you see here, you get out. You get out of Dodge. It's the number one reason to do so when you see insider selling to this degree. All others, forget it. There's really no signal there. Fast forward again to where we are now, and it's off the charts. There's a structural impasse here. I've never seen anything like this. But again, follow savvy, experienced investors in social media, folks. They'll get you done. Now, next year, though, this is an extremely high bar, right? So next year, you'll probably get an improved performance out of energy. It doesn't mean you're going to market perform with energy stocks, and it doesn't mean you're going to outperform. But relative to itself or on an absolute basis, energy should have an improved performance in the next year. Just 2023 has a real structural impasse here. Moving on. Let's go to here first. This is a chart from Jay Capil of the Sentiment Trader. Small speculative index positions. Look how short they are, folks. They are tremendously short S&P 500 futures. Like nothing we've ever seen before, right? Maybe they're not looking at money velocity. I don't know. But look at the smart money flow index. This is the smart money flow index at the bottom. And this is the Dow Jones Industrial Average at the top. And we have a complete bullish divergence going on here. Dow Jones has been trending a bit lower over the last couple of weeks or here in May, and the smart money flow index has been going higher, while the speculators are piling up on shorts. Do you want to go with the speculators or do you want to go with the smart money? Not advice here, folks. I'm just saying, more than likely, this money is thinking long-term. This money is afraid of something in the near term, right? Debt limit ceiling, possibly. Who knows? Right? We've been in this really tight trading range for weeks on end, it seems. Eventually, we're going to break out or we're going to break down. What is likely the catalyst? Debt ceiling. We'll see. Talked a lot in the past about equal weight versus cap weighted S&P 500. Here's a study from Bank of America, Merrill Lynch, about S&P 500 equal weight death cross, which just happened. Should you be concerned? Well, historically, no. 65 days later, the percent time up or the positivity rate in the S&P 500 is 84%. 130 days, 195 days. I mean, they're all in the 70 percentile, but 65-day return is 85%. When you think about, when a particular study or quantitative data has a 70 percentile reading, it's good. Don't get me wrong, but the S&P 500 is up for the year 75% of all years going back to the 1920s. So this doesn't really tell you much. It's just doing what the average year does. But when you get into the 80% positivity rate, you pay attention. You want to lean into that. Lean into that. Here's another way of looking at it from Sentiment Trader. Everything looks weak relative to the S&P 500. The percentage of equal weighted sectors with a positive relative trend score is all the way down here. That sounds bad, right? It sounds like we have very narrow market breadth. Few stocks are actually trading higher. Few sectors within the S&P 500 are trading higher. And yet the S&P 500 is staying, at the top end of its trading range. Very narrow breadth. Something bad has to happen, right? Not necessarily. The 19 prior death crosses on the S&P 500 equal weight going back to 1992 show solid forward returns for the S&P 500 going out from 20 days to 260 days. Here also, from the Sentiment Trader, Dean Christian says the median term outcomes are actually not bad when you have breadth this narrow, which is in keeping with the 84% positivity rate. All right, moving on. Last week on May 10th, I had posted this chart here, and it's the relative performance of small caps versus the S&P 500 cap-weighted index ETF. Unless this time is different, small caps appear to be positioned to outperform. At the bottom, I have the 12-day rate of change. The 12-day rate of change relative to SPDR below 10%, right? Once, twice, 3 times, 4 times, 5 times, 6 times since the Great Financial Crisis bottom. And as you see, when you get to these levels, below 10% rate of change, the IWM outperforms the SPDR. Here we are. The IWM outperforms the SPDR. Here we are. The IWM, or small cap Russell ETF, outperforms the SPDR. COVID, small caps outperform the SPDR. 2022, small caps outperform the SPDR. And we're right down there again. I posted this chart on May 10th. We were at 0.42% ratio between the two. I'm not sure if I have it updated. Let's try this again. 0.423. So far, it is outperforming the S&P 500 index ETF from when I had posted originally. It's not going to happen in a straight line, I'm sure, but history informs of the probabilities going forward. Could this time be different? That's the question. That's the question. But again, everybody always says, well, anything's possible, Seth. Yeah, but I'm an investor. I know anything's possible. That doesn't help me. As an investor, you deal in probabilities. This kind of historical analysis in the performance ratio gives me an understanding of the probabilities going forward. That's the only thing that is practical for an investor. Okay, the debt's going up. The debt yesterday, right? Yesterday, the New York Fed, which does a quarterly report on household debt balances and payoffs, delinquency rates, came out yesterday. And it showed, of course, because debt only goes higher over time. You have a higher labor force. You have more people working. They're getting more paychecks, and therefore they're taking out more credit card debt. They're taking out more student loan debt. They're taking out auto loan debt, mortgage debt, revolving debt. The more people with paychecks, you're going to get higher debt levels. But as I always say, debt goes in one direction, up and to the right over time. It's population. It is not the size of the debt that matters, though. It's the serviceability of that debt. Can you pay off your monthly, bills? Can you pay them off? Whether there's your auto payment, your mortgage, whatever it is, your credit card bill, as long as you can service that debt, then you're not going to become delinquent. And that's all that really matters. This chart right here is the percent of balance 90 plus days delinquent by each different category of loan: credit card, student loan, mortgage, auto loan, revolving credit. Most of them are in a downward sloping position. A couple of them have ticked higher, but they're still below here's auto loans. They've slightly ticked up here after a really nice downtrend, a slight uptick, maybe some mean reversion, right? That's normal, natural, to be expected. But it's still below the pre-pandemic levels. Same thing with credit card loan debt. That's a bigger tick higher, but again, you're still below pre-pandemic period after a pretty good downtrend here, and the greatest downtrend in history. I mean, draw your lines, folks. Right? I mean, this is deleveraging. I mean, the average consumer is very responsible compared to the pre-great financial crisis period. What else? Revolving debt and mortgage debt, right? That isn't, both of these are in long-term downtrends. So when people, cry foul about how much debt is out there, it doesn't matter, have fun crying. The reality is, most consumers are doing the responsible thing with the use of debt. Last week, right, we saw another big spike in jobless claims, and everybody's like, what's going on here? This is starting to get worrisome. But what we learned through careful research is that soaring claims in Massachusetts were the bulk, like 75, 85% of the reasons that initial jobless claims have been ticking higher. What they found, though, was that the state says fraudulent applications are behind the uptick. And that's what you see here. Initial jobless claims, right? Here's Massachusetts, New York, California, Florida. I separated them out here. Initial claims in California, initial claims in New York, initial claims in the blue. Look at Massachusetts, right? I mean, New York claims are going way down. California doesn't really do much, but man, it is all Massachusetts, folks. That is the problem. What we learned recently through careful researching the abnormality of the weekly spike in jobless claims versus the estimates was that there was an outsized number of fraudulent claims in the state of Massachusetts. Over the 8-week ending in April 29, initial jobless claims have increased 34,000. Claims in Massachusetts have surged almost 25,000 over the same period. That's a pretty big chunk of the increase. Renaissance Macro studied this, and these are the numbers that they came out with. We've since learned that Massachusetts has declared many of these claims to have been fraudulently filed with the state. Now let's look at something else. See, this is Liz Ann Saunders of Charles Schwab. And I don't want to say she's digging into it. I'm just saying she's picking headlines and trying to fit a narrative. States with the heaviest concentration in tech or banks, right? California, New York, Massachusetts, suffering disproportionately in terms of jobless claims, initial unemployment claims, right? So she's taking, right? Remember all of the tech sector layoffs that happened late last year into early this year? She's trying to draw the correlation between tech and big money center banks, because Massachusetts and New York and California also have a lot of banks, right? Big money center banks. She's trying to take those narratives and say, that's the reason initial jobless claims are higher. That's what she's doing here. California, New York, Massachusetts initial claims versus the rest of the U.S. And the dark shaded line, and it's a big spike. And in the rest of the U.S. is the down here. So this is the narrative, right? It's the stuff that you see in the headlines. Should I say that's the reason, that's the cause jobless claims spiked higher? But the reality, like if we look at the number of tech employees let go since the start of the year, It's only gone down. It's actually at this lowest level here since the start of the year. So it's not layoffs that are doing this. That's why I say she's just taking headlines, because when you study, it's at the lowest level. You have to go back to September of last year. That was the only time tech level layoffs were lower than they are today. This is not because of tech companies, folks. What else? Now you would think that with layoffs being where they are in these states in question, that consumer spending would be poor. This data from Bank of America: retail ex auto spending per household by metropolitan area. Here's San Francisco, right? Tech, the Silicon Valley. San Francisco had a huge spike in April, right? A huge spike in April from retail spending. New York City bounced back as well. The other major metropolitan areas basically as flat as a pancake. You can't even see the blip there. But they are all positive. If people were actually losing their jobs and on unemployment insurance benefits, why are we getting such a massive bounce back? And specifically from these areas that Liz Ann Saunders calls into question, right? Like I said, this is kind of grotesque what she's doing here. It's not that she hasn't done it before, but it does go to show you how inept some of these strategists from around Wall Street can be. It's easy to take headlines, right, and fit them to the narrative that you want to promote. And that's exactly what Liz Ann Saunders did here. And again, this is from the Bureau of Economic Analysis, retail plus food level spending, going into April. And after that March plunge, probably related to some consumer angst around the banking center issues that were being frequently headlined in your local news and national news headlines, but they bounced back sharply. You're worried about an economic recession with how resilient the consumer has become? This is card spending data from the Bureau of Economic Analysis. Next up, we've got last chart of the day we'll cover. I said we jump around to different subject matter, but earnings, right? What it all comes down to, you as an investor, is follow the earnings, folks. Follow what companies are saying. In this chart from JP Morgan, the percent of S&P 500 companies guiding EPS higher or lower. Higher is the dark shaded line. Lower is the lighter shaded box. Look at the current quarterly guidance. Higher, right? It's the best we've seen since 2021. And quite frankly, like, remember the 2012 to 2017 period? We got above this dotted line, meaning more than 40% of companies are guiding higher once, twice, three, four times since in this 2012 to 2017 period. And we are back above 40% once again. We'll see what the market does going forward. I'm bullish. I'm looking for opportunities to buy pullbacks to position for what I believe are going to be better than expected earnings for the full year, absent an exogenous event, of course. That being said, I'm Seth Golden. Tune in next time to Finom Group. Check out, if you're not a member of Finom Group, you don't get our weekend research report. Subscribe today, get our weekend research report, get our state of the market videos directly to your inbox each week. Have a great trading week, everybody.